Let's get some perspective on the markets in general and perhaps the NVIDIA story in particular. Shares of NVIDIA, as we just saw, extending their recent declines. Joining me now is Jack Janasiewicz. He's portfolio manager and lead portfolio strategist at Natixis Investment Managers Solutions. Jack, thanks a lot for joining us. Fair to say, I think that investors around the world are looking at NVIDIA and wondering what's going on. Many of them are wondering, should I be pushing the buy button today? What do you think?
Yeah, I think, listen, it makes some sense in here to have a little bit of a profit-taking session. The market participants seem to have been echoing this call for quite some time, so maybe now we finally get it. The bottom line here, though, is the chip story over with? Are we done seeing the GPUs being purchased? There could still be some upside in here simply because, that chip is really only coming from one source, and that's NVIDIA, and they basically have a pretty wide moat on that. Question, though, is has that AI upgrade or that AI purchasing really run its course by now? And I think this is bringing me a good chance to let it correct a bit and look to reload at lower levels.
What do you think of the balance sheets and the profit growth performance of mega cap stocks more generally, that very small group of stocks that have led the market higher for so long?
Sure, and I think there's a little bit of concern with market breadth. That seems to be the chatter of late, given the the narrow leadership that we're seeing pushing the market higher here. The issue, I think, going forward, though, is going to be one of a potential growth scare, right? You're starting to see a little bit more soft data coming through. The concern is whether the Fed will retain that hawkish bias, and if they retain that hawkish bias with softening labor data and maybe the unemployment rate ticking up, that might lead to a little bit of a pronounced growth slowdown. And if we get that growth slowdown, might we see those mega cap tech names come back into vogue as they act more like a defensive play, so to speak? So it'll be interesting to see how the market unfolds over the next couple of weeks, especially with some of the Fed speak that's on the dockets coming up.
Okay, what are you buying right now? Are you buying at all right now on behalf of clients? And if so, what?
Yeah, we've actually been de-risking. We've had a pretty good catch in terms of this most recent run up here. Towards the end of last week, we had about a 5% overweight in equities to our traditional 60-40 portfolios for our clients. We've actually since scaled that back down, moving back to neutral. And again, the thematic that we're playing here is simply that we might actually see a little bit of that softening in the growth, and we might get a little bit of a pullback for the potential for a growth scare. But I think any meaningful correction here is one that we buy simply because starting points matter. And when we think about where we're slowing from the U.S. growth perspective, we're still slowing from very high levels, and I think that's the key to remember. So good opportunity to reload at lower levels in here and look for a run into the end of the year.
Where have you been selling? Have you been selling some of those big tech names?
Yeah, we were actually in the mid-cap area of the marketplace and a little bit with the value tilt. We've actually moved back towards the growth tilt and up in cap. And again, trying to get a little bit more of the that more defensive posture, if you will, by being up in cap space and really, the large cap U.S. trade, so to speak.
Okay, and where do you sit on the never-ending debate over growth versus value? Are you pivoting to growth now?
Yeah, we're still overweight growth, and I think the key here is going to be when the market really gets assured confidence that that rate cutting cycle will commence. And I think we've had a couple of false starts over the last couple of quarters here. You've had value take a little bit of the baton and lead the market forward for a short period of time, and then ultimately give it back. And I think that revolves around the confidence in one that the Fed will actually start cutting rates. More importantly, though, the reason why they were cutting rates is not necessarily in this case because of inflation dropping, but growth is slowing, and that growth headwind might actually be the issue that prevents that rally from starting a little bit sooner. So I think we need greater conviction in the idea that the Fed is cutting rates and that growth is just simply slower, but not slow.
What sectors of the market are you avoiding right now on behalf of clients?
Yeah, we're still really avoiding the defensive segment of the marketplace. We had a nice rotation today. You had the selling in tech, but we saw basically the cyclical side of the market continue to hold up. We thought that was a pretty good indicator in here. We just don't really see signs that the market is rolling over from a growth perspective. Again, we're looking for a growth scare, but I think that growth scare ends up normalizing at pretty good levels. And as a result, I don't think it's time yet to rotate into the defensive side of the marketplace. So still like tech, we still like growth, and we still like the cyclicals longer longer term.
What do you see ahead for the Canadian dollar? We've spoken to a rates expert earlier in this program, and he's confident that the U.S. dollar will rise from here versus other international currencies as, of course, central banks in Canada, the U.K., Europe, Switzerland cut their rates while the Fed waits longer to cut its rates. Do you see more strength ahead for the U.S. dollar, and what does that mean to U.S. stock markets?
Yeah, and I think we tend to fall in line with that same view of modest dollar strength going forward in here, and partly because of that interest rate differential. But again, starting points matter from that nominal growth perspective. And when I would look around the world, the U.S. is still, coming in from a much higher level here. So a little bit of the softening on that growth outlook still puts the U.S. in position A, and that growth differential, I think, is also a reason why you'll continue to see dollar strength in here. What does that mean for the markets? Obviously that's going to be an inflation dampener, so to speak. As that dollar continues to push higher, that's also going to, I think, keep a lid on the inflation backdrop, which longer term, obviously supports the backdrop for an easing Fed, and that I think is growth supportive as well. So kind of the shorter term dollar strength, we'll see how it plays out longer term.
As I mentioned to another guest on this program, shares of mega cap oil producers up in a big way in your country and here in Canada as well. What do you think of that sector?
Sure. I mean, certainly very cheap. I don't think we're about to see oil go away at any means. We still have plenty of, refilling of the SPR, and the demand, I think, at the margin will still be there. And I think also depends on what we see with the outcome from the political side here in the U.S. And if we get a Trump victory, that could actually be supportive, I think, for the oil market as well. So the geopolitical risks out of the Middle East, combine that with the supply issues that potentially need to be restocked here in the U.S. and and the cheap valuations within the energy sector. Not surprising that we finally start to see that energy trade start to get a little bit of the